Good evening. You're watching Commodities First right here on ET Now. I'm Ajay Sharma. Let's take you to the headlines. Well, gold is hitting fresh 28-month highs on, of course, Brexit fears. In fact, worries are that regions could actually slip into a recession, which is pushing a lot of investors to safe haven like gold. Silver is trading flat, just about marginally higher, but otherwise too it has seen a stellar rally, tracking gold prices and what is happening on the global Q front. Talk of emerging markets and rupee. In fact, emerging market currencies have strengthened on fresh dollar selling by banks and exporters. Rupee today ended at 67.39 against the dollar. Gold is where all the action is right now. $1,270 is the price which was hit overnight. In fact, this is the best performing asset class on a year till date basis. Even as we speak, it's sticking in the green. 1363.64 is what the global prices are. MCX prices will also come up on your screen. In fact, 32,000 is what it's trading at right now. Slightly off day's low, lower by 100 rupees. Some profit taking is setting in, but otherwise there's a massive amount of momentum which is being seen in gold. So we thought of putting a special discussion for you with a lot of experts joining us on the show. The reasons why gold prices are gaining so sharply in trade. Just in the last 7 days, almost 2.5–3% have been added. On a 1 month basis, 10%, almost 30% this year. So we have got investments experts as well as trading experts joining us on the show today. Naveen Mathur, Associate Director Commodities and Currencies at Angel Broking. Kunal Shah of Research Head at Nirmal Bang Commodities will join us for a domestic perspective. Apart from that, Daniel Briesman of Commerce Bank and Adrian Ash, Gold News Editor at Bullion Vault, will also join in. But let's talk about the global perspective first, and then we'll get you a domestic. Okay, let's talk about the trading angle first on the domestic side. Then we'll get our international guests, Kunal and Mr. Mathur, both of you. Good evening. Thanks a lot for joining us. Mr. Mathur, let me start with you. This correction or profit taking which is set in right now today, do you think it will accelerate, or do you think this dip should be bought?
I think the kind of run-up what we've seen in last 15 to 20 days definitely asks for the profit taking, whatever you say terminology, profit taking or correction, whatever. But I feel that the broader trend still remains pretty strong. But before the new upside starts, we can see a bit of profit taking. For the first time, we've seen redemption from the gold ETF, which itself is a clear indication that things are going to be little rough going forward. So after from 30,500 to 32,300, 400, we are going to see again gold drifting to the levels of 31,750 or 800. This is the kind of correction what I'm expecting on Indian bourses.
Right. Mr. Mathur, what are your thoughts? How are you looking at the situation right now as far as gold goes?
See, Ajay, I think if you see from the short-term perspective, I don't deny that there can be a profit booking coming in. But if you see the fundamental reasons, say from the medium, intermediate term, the reasons have become very strong. The reasons we all know about, the Brexit, the economic uncertainty therefore, and the currency issues, I think would definitely take the gold prices on the upside. As of now, yes, definitely after such a long time, I think 3–4 years of the downside, which we saw continuously year on year for the gold prices, when the prices have moved up, there would be profit booking people who are waiting on the sidelines for the prices to come on the 32,000–33,000 levels. They would enter into the markets for the previous bought positions which they have, and I think they must be executing selling on not on the exchange, because I think exchange does not offer that long contracts, but then on the physical side. But overall, if you see from the perspective of the medium to long term, Ajay, my sense goes off with the fundamental reasons that the markets may take new not the new highs, but at least the last 3 or 4 year highs. 28-month high anyway, we are seeing the prices touching at around $60 levels right now, from $106, $1060 levels from the start of the year. And off late, after the Brexit, and I would say last 2 weeks, have been pretty much, I would say, fabulous for the returns of gold. It was having around 20% returns before this, but now they have given around 40% returns. We are seeing prices touching at around $1,400 levels in due course of time. So I think say around 30-35% returns from the low levels of January, start of this year, are making this asset pretty much, I would say, on a solid state of investors' interest. The ETF buying also has happened, which has seen highs. We are seeing around 900 tons of the ETF stocks right now, the gold ETF, the SPDR Gold Fund, which was dwindling for year lows. So I think the fundamentals have come back for gold as a safe haven, as a currency factor, beyond which I think $1,400 to $1,450 also, if the situation worsens, as I'm saying, if the situation worsens from here, we may see prices maybe going ahead with respect to $1,450 or so.
Right. Stay with us, gentlemen. We also have our global experts joining us. Daniel Briesman and Adrian is also with us. Daniel, let me come to you and start with you. What are your thoughts on the massive rally gold prices are witnessing? Our domestic experts believe that 1200 plus levels are also not ruled out. What are your thoughts in the next coming months?
Looking at the gold,
I can see a massive increase of private customers buying on our platform. I can see that the spike in gold price has actually returned into a spike in customers and spike in new customers as well. So all the new customers are driving into gold and also silver right now.
Adrian, where do you see prices head? Because I was just reading a report by ABN AMRO, which was the best gold forecaster last year. 1425 is their target. What are your thoughts on the factors behind this rally?
I think gold had got very cheap at the end of 2015. It became a very cheap play, and silver as well, especially on the US Federal Reserve not delivering the rate hikes that it had promised previously. That was the initial start of the move. I think then political risk, financial risk and uncertainty, Brexit in the UK, the US election in November, these kind of issues, China's slowdown, of course, these kind of issues have made other investors look at gold again, like they did in the global financial crisis. Looking at prices, nobody expected prices to be here by now in the professional market. The LBMA's annual forecast, I think the highest price forecast has already gone out of 30 analysts. Most of them expected a small rise, possibly flat on the year. So all bets are off in terms of where we go from here now. But to the point of investor demand, what we've seen in 2016 is the return of managed money. Big Western money managers have come back in. What you're seeing amongst retail investors, private investors, household savers, is actually about equal with selling, because people who bought in 2013, 2014, 2015 are now taking profit, because that's what you can do with gold during a crisis. You can sell, you can lock in your profit, and you can use that money elsewhere.
Right. Daniel, though we've all spoken about how economic uncertainty and accommodated monetary policy stance is also a factor, but there is also an increasing view that some amount of terror premium is also starting to build in as far as gold prices go, given how the developments have been in the last couple of weeks and months. What are your thoughts on this particular factor?
Well, the volatility, especially in gold and silver, have increased over the past days, and people are using this volatility as, Adrian said, they're also willing to sell precious metals now, and it becomes very difficult to forecast where the price will be. And currently in this level or stage of uncertainty, we see a lot of buying, a lot of selling, but the price, of course, is still on a spike. So we're not seeing anything going lower than 1,300 in the long term.
For an Indian trader of gold who has managed to, off and on latch onto the rally which is taking place January onwards, what would your advice be, Kunal? What are you recommending at Nirmal Bang to your clients' levels to get in?
I think when you talk about from the level point of view, gold I would recommend somewhere at 1325, 1320, and silver I would again recommend levels like $19. These are the two good levels again to re-enter into long position. The structural issues what we have, the no easy answers to the problems created by the Western central bankers, no easy answers to that, how the bond yields will stop going down, how there will be stability in currency market, how the negative interest rate regime environment will improve. So all these questions are something, the answers are not very easy, and hence going forward gold and silver both looks very attractive. These are the levels that I recommend. On Indian bourses, 31,200, 300, again good levels for gold to go structurally long. Silver, if you ask me, 45,000, 45,500, again good levels to structurally go long. For the again upside target of 50, 52 for gold, again the upside target should be somewhere at 33,000, 33,500. These are the kind of expectation we have from these two commodities.
Right. Very interesting point Kunal raised. Adrian, I'd like your reaction on what Kunal is talking about. In fact, not only that, almost $10 trillion worth of assets right now is parked in vehicles which are actually yielding negative returns. So what are you guys at Bullion Vault researching on or reading? How could trends behave from here on, and what are you recommending your clients?
Well, I mean, we don't make recommendations to our customers. We just enable them to buy and sell very easily and quickly and cheaply. But the trend that we're seeing, I think, from all markets, not just the UK, where demand has exploded, new interest from new customers has exploded in the last month, and particularly after the Brexit result on Friday the 24th. But also we're seeing a very strong upturn in new interest from Germany, from France, from Italy, and particularly from the United States. I think when private savers, private households in the West are looking at the kind of political problems, the vacuum that you now have in London of leadership, there is no political leadership in London whatsoever right now. This creates obviously a lot of anxiety, and rightly so. The pound sterling crashing to 30-year lows, this reflects that. And this is going to start hurting consumers immediately. British consumers, British households are immediately losing purchasing power now. So you're exactly right, Ajay. It is a battle across all central banks to try and weaken their own currency. The Bank of England has had British voters do it for them very, very quickly. But the ECB is not going to be happy at the weakness in sterling. The Bank of Japan is going to be anxious about the strength in the yen. All of these central banks are going to be looking at how can they try and stay competitive with exports. And I think the problems that people are facing in the UK now about political leadership and about currency devaluation, it's clearly a risk. Now in India, your viewers, ET viewers, they know the problems of currency devaluation. The trend, I think if you look at the rupee versus the dollar, the long-term trend continues to be down for the rupee. Obviously the problems at the RBI now, or, the changes at the Reserve Bank, it's going to be difficult to maintain confidence in the rupee, particularly for international investors right now. So I think we're seeing a real trend towards gold as a physical, indestructible asset. It is always a crisis hedge, and I think it is only going to become more appealing worldwide in the second half of 2016.
Right. Mr. Mathur, I would like your opinion on that one. Adrian made a very valid point. He even spoke about the regions where physical demand has gone up. In fact, data shows that global gold holdings in physical form have crossed 2,000 metric ton, first time since July 13. For the Indian investor, because Indian investor is also sitting on very high degree of volatility in stocks, real estate is not doing a whole lot. If they will also start to allocate some funds to precious metals like gold, how would you advise them to go in gold bars or coins straight away, or in a small portion format every month? What kind of returns can one expect over the next 6 to 12 months given the global uncertainty, Mr. Mathur?
Very good question to be asked, Ajay. I think all said and done, for a very good portfolio and to have a very decent risk-adjusted returns, you must have gold all the times, whether it is a good time in the economy, politics or not, or it's a bad time like we are seeing right now in the Western world. I think the gold makes sense to hedge against these kind of uncertainties to an extent of the downfall in risk assets. So I think it's always recommended to take some 10 to 12% of your corpus on investments towards gold. Now, how do you do it? There were a number of ways today. There are actually a number of ways today where you can go and invest in gold. There can be sovereign gold bonds, there can be bars, coins, even ETFs, the gold ETFs. So I think there are a number of options available today which were not there earlier. We used to, if you remember, and we all know in Indian households, we used to buy physical gold, hoard it, and keep it in the safe deposits banks, which is quite administratively difficult to maintain. Now you have options like the sovereign gold bonds, which are very, very good schemes. You get interest and capital appreciation too, tax-free. So but there are options. I would recommend for sovereign gold bonds. I would recommend for the person who's risk averse but still want to be invested in gold, maybe at a little higher cost, to get into gold ETFs. And if a person is looking forward, or if an investor is looking forward for taking risk, then even futures would look good, not for the trade, not for the investment purpose, but definitely for the trading purposes. So I think there are a number of options like the sovereign bond ETFs and trading on the exchange derivatives, commodity derivatives, where one can go in. But I would recommend that 10 to 12% of your corpus should always be invested in gold, because you never know when the uncertainty would knock your door. We did saw gold touching $19-11 levels in 2011 because of the economic crisis, the Eurozone problems. Today, again, we are really in a world which is pretty much uncertain, as all the experts are talking about, that there is political and economic uncertainty in the Western world. The divergent views of the central banks, there is a competition which is going on, may go on with the central banks to make their currency competitive. So I think I think that makes quite uncertain, and therefore the recommendation of around 10% of the corpus.
Fair point. Kunal, I would like you to have the last word. Summing up the entire discussion, Mr. Mathur believes 10 to 12% is a right mix for a portfolio allocation towards gold. In your view, for an investor, what kind of exposure should one have in a portfolio?
Well, it's very interesting, because earlier I used to recommend that one should have 10% of gold in their portfolio, or the bullion in their portfolio. But looking at the way things are placed right now, in fact, that 10% should now increase to 15, or even maybe 15 to 18%, because every day the value of real assets like gold is going to increase. Forget about the price. It's about the value. The value is increasing, and there is one more point adding to the entire discussion what we had. What if China wants to have their currency as world's reserve currency, and they want to have their currency backed by gold, since they are the largest producer of gold? So adding this dimension into this entire gold discussion, gold is must in our portfolio. 15 to 18% is the weightage which I recommend for this asset.
Fair point, Kunal. You made a very fair point. In fact, the data also suggests that one of the biggest buyers of physical gold have been the Chinese central bank. So they've also been adding to their reserves. So I did not really keep that particular point in the discussion, because that would have made the discussion much longer. Big buying by central bank across the world is also something which is aiding the rally right now. Gentlemen, all four of you, thank you so much joining us on the show on that discussion of precious metals as a part of your portfolio, plus how you should approach it on the trading side. We'll take a short break on that note. On the other side of the break, we'll put the spotlight on currencies. Emerging market currencies are witnessing some amount of strength coming in. We'll discuss all of that when we return.